Hi, John.
Okay, good. Cassie's in the audience, so we'll bring her up when the item is up. John, can you test your mic to make sure we can hear you, and then we can go ahead and start.
Can you hear me okay?
Yep.
Very good. Sorry, I'm late. My apologies. I'm technologically illiterate, so.
No worries.
Okay. So I think we have a quorum, so we can go ahead and start. The chair will not be here today, so I'll call roll call first. We have member Whitesole is here. Member alternate McQuaid is here. And member Sue is here. Chair Rowden is absent, and as well as member Ford is absent. He might join later. He didn't tell me that he's not coming. So would somebody like to read the land acknowledgement?
It's not on here. Hang on, let me find one that has it.
Should be on the agenda.
I don't think it's on this agenda.
Okay, well,
hold on, I'm looking for one that has it. Like every time I click on these agendas, it's coming up not found, but wait. Okay, here we go. I don't on that one either. City Council. All right, I know it's on this one because I read it the other night. Okay, ready?
mm-hmm.
The land acknowledgement. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lejeune. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home.
Okay, then we move to consent calendar. Any questions for consent calendar?
I'll move consent.
I'll second. So member alternate McQuaid?
Yes.
Member Whitesole?
Yes.
And I vote yes. So consent is approved. Public comment. I don't believe we have any because the only member in the public is our financial manager. Is here to answer questions. Any announcement by any members? Nope. Okay, reports. Dewey, it's all yours.
All right, thank you. Let me share my screen. Can everyone see it all right? Okay, so this is a first quarterly review of the pension portfolio that we manage. On this page is the value of the portfolio as of the end of the first quarter, 3/31/2022. This is how the portfolio is allocated, roughly 9% in cash, $331,000, 37% in bonds, $1.29 million, and roughly 53% in stock, $1.87 million. Total portfolio at the end of the first quarter is $3.5 million. This is the value change year to date. So for the first quarter, we ended the year last year, the value of the portfolio at $3.57 million. The income generated from the investment this year was $15,457. The value of the investment was slightly down $89,000 from the fund that we invested. And this is the value at the end of the first quarter, $3.5 million. Next page is the change in value since inception. So similarly, we started the portfolio at in 2009 at $10.9 million, roughly $13.9 million were distributed. Income generated over the last 13 years, 2.25 million, and the gains from the investment about 4.26. So the total return from the portfolio for the last 13 years, $6.5 million. And net out the value of the portfolio, 3.5. This is the performance result for year to date, the last 3 years and since inception. So year to date, the portfolio return negative 2.06% in a down market. This is a relatively strong performance number comparing to what the overall market provided. So in terms of bonds were down roughly 4.5% on average overall, and in terms of stock, the S&P was down 4.6%, and the Russell 1000 value index was down about 0.75%. So overall, relatively strong performance year to date. The outperformance was in the stock fund, up comparing to the market, up 1%. This fund, as you may remember, is focused more on the core and have a value tilt. So value stock have held up relatively well during this downturn in the market. Over the last 3 years, this portfolio returned 8.7%, and since inception, it's been 7.6%. Any questions so far? I'm going to go over our market monitor outlook for the second quarter and the rest of the year. As we look back in the first quarter, this is the first quarter in a while when we saw everything went down together. Stock went down, bonds went down. The only thing that went up were commodities, basically. All the commodities, oil and gold was slightly up. This is what the numbers kind of indicated what we have seen, very high inflation numbers the last few months. So commodity has been big drivers of inflation. Overall, US stock, the S&P was down 4.6%. International markets were down more. This is due to the war in Ukraine. Going into this year, in January, international stock actually outperformed the US before the war. And basically when the war broke out, international got hit much harder than the US. Stock recover into the last 2 weeks of the quarter. At the low of the quarter, US stock and international stock were down much more. But stock recover at the end of the quarter. So the quarter we at the end we saw US were down 4.6%, but the number, if you look throughout the quarter, was much more volatile compared to what we're seeing right now. In terms of bonds, this is the first in many years since 2018 that interest rate has gone up relatively significantly in a short period of time. So prices on bonds has gone down quite dramatically. If you look at long-term treasury, down 10% for the first quarter, middle intermediate duration or shorter term bonds were down roughly 4% at 5% as well. Our outlook for the second quarter and the rest of the year, going into this year, we expected the market to be more volatile comparing to last year. Last year, if you remember, we didn't have a lot of volatility. The market pretty much were on a one-way up. We expected the market to be more volatile, but the US economy and global economy, we expected to grow, continue to grow. With the war happening, we kind of revised our outlook for the rest of the year. So going into the second quarter, we still expect the US economy to grow, but our number, the growth number is less strong comparing to our view just 3 months ago. We expect global economies to significantly slow down, and this is due to the increase in commodity prices. The war kind of disrupt the supply chains, which were affected by COVID and hasn't really recovered, and now there's more disruption. So we expect supply chain to be more constrained, continue to be more constrained. And because of that, we expect inflation to continue to run higher. And as a result, bond yields will have to go up. The Fed will have to continue to fight inflation more aggressively by raising interest rate, and that would create a push for interest rate to go much higher. And with all of that in front of us, we expect stock market to be a lot more volatile for the next few quarters, at least the second quarter. However, looking forward to the end of this year, what we see is still very strong labor market and continue to be strong corporate earnings. So we expect higher volatility, but we still expect the stock market to perform and to go higher by the end of this year. From now to the end of the year, certainly there'll be periods where we have a significant drawdown, significant recovery, but we still expect stock to perform from now to the end of the year. And our view is, as our expectation rates will continue to go up, equity stock will outperform bonds over the same period, so from now to the end of the year.
I got a question for you.
Yeah.
That's all right. So is there like a percentage that you're saying that the year end where stocks and equity is going to be significant?
So yeah, so going into the year, we expected the S&P to perform high single digits, so anywhere from 6 to 9%. But that was going into this year. With our revised number, we expect it to be low single digit to mid, so anywhere from 3 to 5%. This is relative to where we were at the end of last year. So if you know, based on that view, today, and just at the end of today, the S&P was down 12% compared to from the beginning of the year. So there, you know, if our view is correct, we expect quite a significant recovery from here for the market now to the end of the year. In terms of U.S. economy, as I mentioned earlier, the data still shows a very strong job market. Actually, it's labor right now is big force of driving inflation. Very low unemployment right now, and still persistently high inflation with the labor costs increasing significantly. That's going to keep inflation high for quite some time. But the positive sign is still consumer balance sheets is still strong, even though there's a significant drop in consumer confidence. So that's a concern where the equity market is looking at. But overall, for the economy, we expect it the economy to grow slower, but still grow. Global economy, on the other hand, is quite different. Going into this year, there were a lot of talk about global synchronized growth, but with the war happening and more supply chain disruption, emerging markets is really under pressure because emerging markets rely a lot on commodities, and that has a very strong effect on emerging markets, as well as the developed market, Europe and Japan, with the supply chain disruption that's really put a strain on global economy. Another big thing is China. There's a COVID spike over there right now, and they have a zero COVID policy still. There are a lot of shutdowns, so supply chain is going to continue to be disrupted, and that's going to weigh on global economy. There's a lot of discussion about a recession globally. We don't expect a recession in the US, at least for this year. Certainly, there will be a recession, but in terms of time frame, we don't expect it to happen this year. Globally, it's a different story. So there are signs of significant slowdown across the board. And just to make a point, the pension portfolio, doesn't own any international stock anymore. So we sold out of international early last year, and we haven't added any international in the portfolio. So on the equity, it's just domestic large cap, and on the bond side, it's just corporate bonds, US corporate bonds. I'm gonna skip the next few pages. Talking about I want to talk about U.S. equity. As I mentioned earlier, we expect more volatility, and if you follow the market the last week or so, there has been significant volatility. It has to do with the expectation that the Fed will have to be very aggressive in fighting inflation. A lot of the members on the Fed had come out and said they had to act swiftly and decisively, and that could means that the next meeting they expect to increase lending rate 0.5%, and some members even mentioned 0.75%. That's very aggressive from the tone that they had just 6 months or 3 months ago. So stock has have kind of reacted in the same way. Valuation of stock has a lot to do with the discount rate that interest rate it's showing. So as interest rate is expected to go up, valuation on stock is under pressure. But in terms, I did mention earlier, in terms of valuation, we see some volatility, but it has to do also with earnings, and our view is earnings will continue to rise. There are strong corporate earnings. There had been last year, there were a lot of buybacks, and corporate balance sheet is still very strong. So as earnings to show strong numbers, we expect volatility to happen, but the recovery will soon happen after that. And with that, this is our view overall, it hasn't really changed in terms of asset allocation. We still expect equity to outperform fixed income. Now, this quarter, I actually added some of the cash that we had set aside more into bonds, because over the last couple of years, we have run very underweight bonds in the pension portfolio. This has been always a balanced portfolio, 50 stock, 50% bonds. At a certain point over the last 3 years, it had gone up to about 60% stock and 40% bonds or cash. We want to maintain the allocation a little bit closer to the target now that interest rate has gone up relatively significantly. But overall, we still expect bond to underperform versus stocks. So even though I added more cash to bond, the allocation for the portfolio is still anywhere from 55% equity to about 45% or 40% bonds and cash. Globally, as I mentioned, international and emerging markets, we expect to be under pressure, continue to be under pressure. Again, we don't own any in the pension portfolio, and we expect real asset, basically infrastructure, investment, MLPs, and real estate to continue to perform. We don't own these type of assets in the pension portfolio. And that concludes my report. Is there any questions that I can help answer?
So you say we don't have any real estate stock like Nuvian or whatever in the portfolio. Are you recommending that we consider that, or?
So we expect these asset class to outperform. I don't advise on adding these type of investment in the portfolio. So there are some stock in the fund that actually have some real estate exposure, but we don't have a dedicated fund invested in just real estate in the portfolio.
So I guess I'm just trying to get some direction from you. You're recommending we maintain the course as to the percentage of our portfolio?
In terms of the investment on the equity side, yes, maintain the equity allocation with the fund. We have always maintained Dodge and Cox fund as part of the investment for the pension, which is maintaining that investment in Dodge and Cox.
The other thing you mentioned about you don't expect a recession this year, but possibly next year. Did I get that correct?
That is correct. Now, in terms of over the next 12 to 18 months, the next 12 months, we don't expect a recession to happen, but beyond 12 months, there are a lot of variable, and it has to do with how the Fed maneuver this raise in the interest rate, how aggressive they are. If inflation, continue to persist and at this, 7.5%, 8%, they have to really significantly slow down the economy to fight that, and that could put the U.S. in a recession. There are some of our economists believe that right now at this point in time we are at peak inflation, and there's some, if you expect some gradually decline in inflation, then the Fed may not have to be that aggressive, and that could delay that the time frame for that recession beyond 18 months. But beyond 12 months, there are a lot of variables. Any other questions? All right, and that concludes my presentation. Stop share.
We thank you very much. It's always a pleasure and informative.
Thank you, and I look forward to seeing you all next quarter. Appreciate the time.
Thank you.
Thank you, Dewey.
Yes.
Hello.
Next, we have a discussion item, update to retiree pension payments. Anyone has questions? We have Cassie Murphy, our finance manager, here to answer questions if there are any.
No, I didn't have any.
Okay.
I guess we need to move and second and approve for the pension payment.
Make a motion, we approve the pension payment.
I'll second.
Okay. So member McQuaid, member alternate McQuaid, sorry.
Aye.
Member Weitzel,
Yes,
and I vote yes. So the motion carries. So Cassie, we have that approved. Thank you for attending.
Sure.
Okay, then we have future agenda items. Anyone have any items that they like to suggest to for future?
nope,
Okay, so our next meeting is normally it would be in August, but because of the August recess, we are trying to find a date for the end of July. And right now it looks like because of all the public meetings that we have, and a date that's available is July 26th, which is also a Tuesday, and at 3 o'clock. So we'll find out if we are able to have a quorum that day, and then otherwise it would, if we do have a quorum, then the meeting will be set for July 26th, Tuesday at 3 o'clock.
sounds good.
Okay, so meeting adjourned within half an hour.
All right.
Thank you very
Yeah.
much.
Thank you.
Bye-bye.